Hey everyone, I do want to welcome everybody into the Polaris Capital Group webinars. We're joined here today with Rob Sechrist. He's the president and co-manager. Good to see you, Rob. How are things?
Doing well. Thanks for hosting us today.
Yeah, I appreciate it. And I appreciate everybody for logging on here today. A lot of stuff that we want to uncover and educate people on more. Travis Goad, I think he's on with us right now. If not, he's registering right now, but he's going to be part of this, one of the panelists today. Good to see you, Travis. If you're on, great to hear from you. If not, we'll be on momentarily. I guess I know the answer. He'll be on momentarily. All good. But I guess to tee things up here today, the objective for today's webinar is to educate retail investors on the company's core business, which is understanding the banking and lending landscape in cannabis, regulatory reform on the horizon, differences between equity REITs and versus mortgage REITs, along with cultivation and more notably the California market. So I think right off the top, Rob, your company is changing its name from the Polaris Equity Group to now the Polaris Capital Group. So can you explain then why the new name for the organization and why you're making this transition?
Sure, and thanks for asking the question. So, when we formed Polaris Equity Group back in 2010, at the time was after the great financial crisis, and we had put out together the first lending product that made it so borrowers could borrow without having to have any skin in the game back then. And we basically teamed up with a hedge fund behind us. We did a 50% loan to cost structure. Then there was an equity group that came behind us with the additional capital. And so that was designed, and that was the first person that we were the first ones to design that product. And so we named the company after that. In addition to that, Polaris Equity Group is actually a California registered licensed broker. And that's good. It gives us the licensing to lend in California to do the things we do. When we formed the fund in 2018, the fund actually has its own licenses, and the fund is actually able to lend nationally. And so over time, the fund is originating and doing all the transactions itself. And so what we have been doing is pulling away from Polaris Equity Group, which is the broker, and shifting over to the sponsor of the fund, which is Polaris Capital Group. So there's no changes. The owners are all the same. Everything is the same. It's just that Polaris Equity Group is a licensed broker for the state of California. The fund is still managed by Polaris Capital Group, and all the licenses are under the zone. So we're just been making that shift over.
Duly noted. So right off the top, I think like the way we want to break down this webinar is into segments. So let's begin with the banking side of the business and the specialty use cannabis lending business in which you operate and how you maneuver through it. So right off the top, how exactly do you raise money to lend to your clients?
Yeah, so for us, we raise money through both retail investors and institutional size check writers as well. But we bring those funds in through traditional banking means. What we try to make sure and let retail investors and investors in the sector know is that there is banking in this sector. The last year that FinCEN had it on its website, there was 684 cannabis-related banking depositor relation banks out there. And that means that those banks could, handle both tier 1, which is plant touching, or ancillary, which is tier 2/3, which is what we are. And so I think that one of the biggest misconceptions about the cannabis landscape out there is that there is no banking, and that's not the case. Not only is there robust depositor banking out there, but there's also banks lending. We've heard as many as 400 are lending. We've only been able to track about 4 dozen of them, and we have been paid off by banks. So there's both federally chartered, state chartered, and community banks, both doing depositor and lending in the country. And so I think that what I think that the cannabis related depositors and borrowers would like to see is more competition, and that would bring down the fees and the requirements that these banks, these specialty, the cannabis friendly banks have out there. You have to realize that to board cannabis deposits, there's a compliance that's necessary for the cash for each one of those deposits, and it might be different in each one of those states. And so it's not worth losing your banking license to just board a few $1 million, even if it's $100 million. It's inconsequential for a bank.
Okay. Travis, good to see you. We also have panelists Anthony Verrill and Benjamin A. Smith on with us. Ben, I know this is you've had some really good questions regarding banking pertaining to some of the conversations we've had around in the past, but is there anything you wanted to touch on that you think would be beneficial for investors to know about the different levels of banking that's taking place?
Yeah, that's actually a question I wanted to ask for Rob. The different banking tiers and who Polaris deals with in terms of going through these different tiers. Can you explain that to the audience so that they have a better understanding of who you deal with?
Yeah, so if you're asking the names of those banks, we keep a list of all those banks that we are tracking, the ones for the lenders. We don't keep a list for all the depositors, but I can tell you that off the top of my head, Western Alliance is one of them, which you've heard about in the bank. First Republic was one, Signature Bank was one. And so those were relatively small cannabis friendly banks where there wasn't that big a concentration. We currently bank with Needham Bank, and they are a cannabis friendly bank, but they also hold additional deposits in that. There's lots and lots of banks that do some banking in the sector, but some have really focused on the sector. East West Bank is a federally chartered, fairly large bank. They're probably one of the larger ones, and Western Alliance are probably the two biggest I could just think of off the top of my head.
So have you been affected at all by some of the? I think Western Alliance was in some trouble. Some of the regional banks. Have you bypassed any sort of ramifications of what's going on right now?
We think a lot about this. We do daily treasury management and watch how all of our banking is happening. But our bank, Needham Bank, actually has depositors insurance fund. And this is what a lot of state banks and community banks and other types of banks, one of the things that they use to mitigate risk. And so for Needham Bank, they have a fund that protects the bank's deposits in excess of the federal FDIC limit. Anything in excess of that, the entire bank has up to 1.5 billion additional insurance. So that gives us the comfort that even though we're in a not a systemically important bank, that we're in a bank that is safe and is able to manage and get through these tough times. In fact, Needham Bank is Silicon Valley Bank. Second largest hub of depositors was Boston, Massachusetts. And so they got an enormous amount of inflows from that. And the other thing is that cannabis friendly banks actually have sticky deposits. They really don't have another place to go to. And so that's an advantage for them during some of these turbulent times for the banking.
Rob, you've mentioned in the past that out of the 684 FinCEN listed banks, only about 15% of these banks actually participate in cannabis lending. So why do only a small percentage of banks participate right now?
Yeah, so that 684 banks is roughly, I think it might be a larger percentage now, but roughly 4,500 banks across the country. It's just that it's a lot of headaches to have that compliance department set up, because if you get that wrong, now your entire banking license is in jeopardy. And so even some of the banks that come into the sector, once they've had their first audit that is from the federal level, a lot of them pull out of it because it's just not worth the headaches. They're not making enough money off of the deposit relationships, and not as many are doing lending in the sector.
Okay. Yeah, I guess speaking on those banks, do you see the large money center banks coming into the sector even if SAFE passes, or there you see them kind of like being like, oh, what kind of want to sit this out from I guess a risk perspective and just let those SMBs keep generating that business and just kind of take a watchful eye in the beginning?
I've thought about this. I thought about what happens if a cannabis-friendly bank is taken over by a systemically important bank, and what would happen in that circumstance. And I think it would be just the way it would be treated for any cannabis-related depositor that is realized within the banking system. They give you 30-day notice to exit the bank, and they don't talk to you. And then if you don't have your money out, they send you a cashier's check. So yeah, that's how that would be handled. I'm just guessing. But to speculate on what would happen if we get some legislation passed like safe banking that deconflicts state policy from federal policy, I don't feel like the systemically important banks are going to rush into the sector. They they have so much other things going on, and they're so massive that I just don't see them pivoting to this spot. And there's also the moralistic and reputational things that go along with that, and they just don't have the need to go there. Maybe someone does, but if I was just to guess, that would be my answer.
Okay, so as we know, Rob, like I want to touch on like credit cards, and processing is a problem at dispensaries and serves to minimize sales potential versus, say, regular businesses, since credit cards, as we know, are processed on the federal system. So companies have been hesitant to allow processing due to cannabis federal illegality, excuse me. When do you believe credit cards will be part of the retail framework? Do you have an idea?
Yeah, so, just to kind of unpack what Chad's saying there for the audience, is that the primary reason there's so much cash buildup in these businesses is that credit cards are processed on the federal system. And so you cannot use a credit card in the dispensary at that initial point of sale where that cash is initially generated. So you get a buildup of cash, and then they've got to clear that cash out once a day or once a week and keep it in the safe, and then go to find a bank that can board that cash that's a cannabis related tier 1 banking, bank friendly bank. And so that's why and then that cash, everybody's trying to pay the cash with the rest of the service providers or their cost of goods or whatever it might be down the line, so that they're having to board less of it. Most cannabis friendly banks for tier 1 banking either have a minimum deposit requirement to keep on hand at all times to offset those compliance fees that are necessary for that, or back in the day you would pay 0.2% per deposit or something like that to offset those costs.
Let's switch now to the conversation to lending and your managing partner, Travis Goad, who is prominent on the lending side of your organization. Travis, I guess the first thing I'd like to ask you is to explain to the audience the differences between a specialty use lender like yourself, Polaris, and that of a traditional bank lender.
So being a specialty use lender, we're allowed a little bit more leeway in how we think about risk, and we're able to be think through a new industry. So as this industry has grown and the opportunity on the real estate sector has grown with it, it requires kind of a little bit of a hybrid approach in understanding the lending, not only from a real estate side, but understanding the operating business side. So it's a little bit different than your traditional real estate lending, even though it looks and feels very similar. And so banks tend to be very highly regulated. They also have not as much incentive to kind of get up to speed on new industries as something moves so quickly. So a firm like ours, we're incentivized to fill the gap in the capital markets that we've seen, and really have spent a tremendous amount of time understanding the market, the landscape, and how best to deploy capital in a risk-adjusted way.
So I guess that pretty much answers my next question. Is I was going to ask, like, why can't operators apply for capital at a traditional bank? Because they are the highly regulated, if I'm understanding that correctly.
Correct. They're highly regulated. And today, for instance, cannabis is put in a slightly different bucket for them. And so they'll have caps on how much they can have exposure to these different things. And for us, we are a cannabis specific lender. We are all cannabis. So we don't have that cap. We're designed and set up specifically to, take advantage of this market opportunity.
So how insulated is your business then in the event that, say, cannabis normalizes and banking services become fully functional within the industry?
So we think we are insulated, and there's a couple of ways I would take the question is, we do expect more competition to come in. We do expect safe banking to impact. I don't know if it'll change the lending landscape, but it will certainly, or at least should change to whether you can take a credit card at the dispensary or not. But one, there's a learning curve people are going to have to get up to speed on in the industry and how to deploy capital. We have a data advantage. We founded a separate data company. We've been collecting data since 2020 on a time series basis. Every month it's updated. We're scraping data from 100 different sources into a proprietary database. So that's one knowledge moat that we have that we think will protect us. But then two, in a world where banks are not so limited in what they can do in cannabis is a world in which our cost of capital drops as well. And so because we're still a cannabis specific lender, we don't get to access capital markets as efficiently as other traditional mortgage REITs do.
Right.
We would expect that in that environment, our capital markets access opens and we can continue to deliver market beating returns to our investors.
Now, Travis, I know you can't speak specifically on the banking side, but from your experience with the clients that you deal with, do you think they're more comfortable knowing that you're a specialty use cannabis mortgage lender, or sorry, lender, and they rather deal with a smaller company like you who knows the industry rather than a bank who may not know the nuances of the lending environment?
100%, and we see it. I mean, the few banks that we know that have closed lending transactions, it takes them, one, there's a tremendous amount of execution risk because of the lack of experience in the space and understanding a new market that's highly regulated. And so what we've seen of the banks, if they do close a loan, that it can take upwards of 12 to 18 months we've seen on closing timelines. So that's a very difficult closing timeline for any real estate transaction.
Yeah.
But if you're looking for certainty of execution, and what happens is it'll go up to levels of the board and the board will push back and then they'll go and come back. And then there's this whole back and forth of ultimately getting somebody comfortable with a relatively new type of loan. But we've seen more transactions in the space than anybody else. We've deployed over 500 million of capital into the space. We have over 100 million of payoffs that we've seen. So we have a track record of deploying the capital and having it returned to us and then redeploying it again. And so a lot of the hurdles that you have to go through to get comfortable with the space, we went through and solved, 7 years ago, and we're comfortable with it. We know how to understand the space and deploy capital. So if there's a borrower out there that wants to wait 18 months to potentially close a loan, they certainly can do that, but it's not really conducive to kind of a fast growing industry and getting capital to people when they need it.
18 months can make or break a cannabis company. That's for sure. Right.
Correct. And it's just longer. And it's not to say every bank takes 18 months, but we've seen it take that long. Where we've talked to borrowers, he said, we're working with the bank and we check in every once in a while, and it's taken that long in some cases.
So let's say like banks do get involved, safe banking passes. Do you think that you'll get a lot of attention from banks on advice and direction on how exactly you were able to build out a model that has been, let's say a great track record, knowing the amount of years that you've already been involved in it?
Yes, we've seen that already. A few of the banks that we've done business with that wanted to look at, hey, would they want to look at direct lending? They'll come to us and say, hey, can you basically teach us how to do it? And we've had those conversations. But we do think we'll see interest from that. And we do think that what we've seen kind of a trend in the banking space is that if a new bank announces that they're entering, they'll usually close a handful of transactions in the space. And then what we see, and this is very common in every other real estate lending sector, is that the banks will say, well, I could either lend direct or I could lend to the lenders, and I'll turn around and they don't have to staff the same amount of origination team. They don't have to get up to speed with all the last dollar credit risk and other things that you would see by doing direct lenders. And they can be in a safer position and lend to a fund like ourselves or other ones. And we've seen that with some of the big banks. They came in and closed a couple of loans, and then they start calling us and saying, hey, could we maybe provide you a line of credit? We would rather do that than do it direct. And so we expect that trend, which is very, very common in real estate lending, will continue.
Okay. Let's focus on the different types of real estate investment trusts that investors can invest in. Some publicly traded, while others are private. So maybe explain the the differences of mortgage REIT and the standard real estate investment trust that most investors are probably familiar with.
Sure. So the key differences are traditional REITs own and operate the real estate. If you're thinking about it as a cannabis sector, the only actual REITs are what they call sale leaseback REITs. So they own the real estate and they lease it back to the underlying operator at call it 15 to 20 year lease. And they'll buy it at 100% of the cost of the facility. So they're owning the real estate and they're entering into a long-term lease. What we are is a mortgage REIT. So we don't own the real estate. We make a loan against the real estate, and we're collateralized by the real estate company as well as the operating company of the underlying cannabis business. And so we are in a lower risk position than some of those other REITs. So if you think about a sale leaseback, it's inherently, even though they own the real estate, and I want to make a clear distinction, a regular REIT owns the real estate. But when you enter into a long-term sale leaseback, it is kind of like a debt transaction from a cash flow and risk perspective. And so you're effectively, if you think about it in debt terms, you've bought the facilities 100% at cost. So you're effectively 100% loan to value loan, and you have a 15 to 20 year payback. And so this industry is hard to get right over the next couple of years. Having a view over the next 15 to 20 is exceedingly difficult. And so what we do is we'll lend between 60 and 75% of the cost of the real estate. So borrowers need to show up with an equity check so that we know our incentives are aligned and we're not taking last dollar risk. And our loans are typically 18 to call it 36 months. They can be as up to 5 years, but that shorter window allows us to kind of adjust and pivot as the industry changes and look to either de-risk or kind of continue to lend into strategies that are working.
Do the shorter durations sort of not scare client, put prospective clients on notice that just with the shorter duration of the loan in terms of not having a 10-year or 20-year mortgage like traditional banks might lend?
Yeah, so very good question. In commercial real estate, it's very rare to see anything longer than a 10-year loan, even though you may amortize on, say, a 20-year or 30-year schedule. So you're typically going to be in 5 to 10 year on the commercial front that needs to be refinanced. So, yes, sometimes borrowers would like less uncertainty and longer duration loans. However, they ultimately get comfortable with it because as long as they're doing what they say they're going to do and they're paying their debt service and operating, we're fine to extend their loan or redo a loan to them because we like good risk on our book from good sponsors. So it's really about forming those relationships with our sponsors and giving them assurances that we're not some of the other players in the space don't have the long-term vision that we're focused on building the #1 non-bank lender in the cannabis sector, and they look at it as more of there's some dislocation in the industry today. I'm going to come and put out some, high yielding loans. And then when the market shifts, I'm going to just leave and do something else. And so that actually scares borrowers because they don't really have the certainty that they're building a long-term relationship. So
Right.
for us, we're saying we're in this space for the foreseeable future, and we expect to treat you well and continue to grow with you.
I want to bring Rob back.
I didn't
Go ahead,
mention the data moat, Travis, and that being some of the, I guess, something that's defensible. Are you guys leveraging AI at all in the underwriting process or anything to that extent yet?
So we're just starting to kind of layer in some AI type predictability stuff on our data. It's not, with that kind of predictability in AI, which is an exciting term, you really need a ton of data points, and the industry is relatively new. So typically, in my experience, that stuff specifically with relatively illiquid asset classes, the predictions aren't great. But as we continue to get more data points and we continue to just the industry continues to mature, I think that those predictive abilities will grow. But we are definitely exploring those. We're definitely, I would say more than, but exploring and running some analysis around that to see how useful we think it is at this point.
Okay.
Rob, I want to tie you back into the conversation and talk about cultivation on the cannabis side. You've had a great grasp on the business side of cannabis, even though you're not an actual operator, but due to the many companies that you remain in close contact with on a regular basis. So first question, I want to ask from a lending point of view, do you have, I guess, different underwriting requirements for indoor versus outdoor cannabis cultivation? If so, what are they?
Yeah. So just to clarify, and thanks for asking the question, we don't do any outdoor. That's not what we do. We don't do ag transactions. And, when you hear about, for example, the California market, and you hear about all the hype of licenses not being renewed, and all the compression of the pricing and the commoditization, that's primarily the outdoor market and the wholesale market, and the pounds being, product being sold by the pounds. And, that's not the sector that we're in. And just to kind of educate our audience here, outdoor cannabis can typically only be grown basically once a year for October harvest. You might be able to squeeze out one more harvest with some tarps and some other things to try to squeeze something out of that, but not this year because of the rain and the clouds and the temperatures. You'll be lucky to get a full yield of the October harvest that's coming. But that quality of product for outdoor is the lowest grade product and the most commoditizable product that is issued in the industry. That product is ultimately, in our view, and I was just speaking with somebody that's really steeped in this last night, and it's pretty much, this is a person that's part of a major group of California cultivators, and they all pretty much know that the outdoor cultivation is that market is on its way out. If you're not able to get your product into distillate for things that are not going to be flower based, sold by, so you can be buying flower, that product is never going to compete with stuff that's done indoor. And indoor comprises of two categories. Mixed light or greenhouse is another term for that, and just true indoor. And so that flower from the outdoor is not in direct competition. All that poundage, all that stuff, all that product out there is not going to be something that is competing with our indoor. But you'll have to come back. I got a delivery coming. And so the indoor cultivation is a perpetual harvest. And so that the next higher level is the mixed light or greenhouse, and that is getting closer to a full perpetual harvest. It does have some factors of lighting. And then for the indoor cultivation is for perpetual harvest. And those are the highest yields, highest consistent quality, and the highest caliber of product that that you can be putting your brand on the shelf all year round.
Now, Travis, do you keep track of pricing, even though you're not an operator? Is that one of your key metrics that you look at in the data system that you're talking about?
100%. We definitely track pricing, and pricing is pricing tends to be relatively volatile, and it's something that we keep a track of very much so, because it impacts the profitability of operators and impacts how things are. There's a couple data sources that will track it by indoor, outdoor, etc. So we'll look at some of that, but we get a lot of great real-time data from our operators. So, long before any of these data services will pick anything up, we will, anecdotally be talking to our sponsors, and they'll say, hey, prices are trending up or prices are trending down. And here's what we're seeing. Here's the last thing we sold this week on the bulk market. Here's what we're selling at the end user consumer level. And here's this. And so, it's just really great data that we have because we have such a wide footprint in the space. And typically what we see is, there's periods of oversupply and undersupply in all of these markets. It's just a natural as the market kind of reaches stabilization. And so we were able to look through and get comfortable that, hey, we're looking at different metrics and seeing, yeah, there's an oversupply now, but we think it'll shift because this product is not like oil. It can't sit around for huge amounts of time. It's perishable. Anything after, say, 3 to 6 months is just getting a little bit old. It's hard to sell, etc. So even during periods of oversupply, it'll go away and it'll bounce back. And we had high confidence in this last year. California had a very, prolonged oversupply for most of last year. Greenhouse was selling in some instances for as low as, call it, $350, $400 a pound. And kind of year to date, first quarter of this year, prices have spiked up to $800, $900 a pound. So they've more than doubled year to date. And we think it's a combination of things that's happening. But that's kind of natural. And it was funny, you would talk to some people last year who haven't been in the space as long, and they would say, oh, California is never going to come back. It's so oversupplied. It's going to look like Oregon forever. And I heard this from so many people, and we were confident that it would eventually bounce back, and it did. So it's just understanding the market you're in.
Yeah, I was going to actually go ahead, Anthony.
I was going to say, from a portfolio construction perspective, are there any assets that you guys gravitate towards? And are there any assets that you prefer not to, I guess, lend on, whether it be like cultivation, manufacturing, processing, retail? Are you up and down the chain as long as the assets meet the criteria of your underwriting process?
We're up and down the chain. It's more about market supply and demand that we're looking at, and specifically on how many real estate assets exist versus how many we think need to exist. And so we look at that. Most of the facilities in our book are what we call mixed use. So it skews really towards cultivation, but there's usually a cultivation, manufacturing, processing, all within the same facility, so they don't have to ship it back and forth. Now, some states mandate that by law, like for instance, in Florida, everybody that touches the flower or the plant has to be your employee. So they force you to have full vertical integration. But in other states like California, it's different. You can have a separate distributor's license. You can have a separate manufacturing only license and a testing license, and you can have a separate cultivation license. So we have an operator in our book in California, and they do co-packing and manufacturing. So they have a full commercial kitchen. They'll make your specified beverage or edible to your specifications, or they have their own formulas that you can white label your product, and they'll also package your flower into state compliant packaging by the date certain. And so that's an example of that's the only function they do. They don't cultivate, and they have a unique business model that's doing well.
I think this is an important thing to bring up. We've seen a lot of public equity companies pull back out of the California market. Just can't compete in so many levels. But, we're seeing, and hearing from some influential people who, I guess, work closely and track wholesale prices in California. And they're saying that they're seeing a dramatic upturn in pricing within the state this spring. Maybe explain to our audience, Rob, the difference between public and private side, how the California market is the biggest cannabis market in the world, and why it's such a lucrative opportunity for you and your business.
Yeah, so because it's the largest market under one compliance, as a lender, for us, we need to be able to make sure that we're in that market. And it also, as a lender, means that it's the easiest to replace a tenant or a cannabis operator if we were to take a property back. So that's the primary distinction. And there's been many multi-state operators that have entered into this sector, or the state of California, and have been unsuccessful at that. And I think that one of the reasons that is occurring for them is that when you have an unlimited licensed state, it is with the most experienced operators essentially in the country. It is a very competitive market. And if you have been only operating in limited licensed states, and you're trying to bring that thought process and that the way of thinking about things, you're probably not going to be able to compete competitively in California, even though you're this massive operation. So that's kind of what we've been seeing, or figuring out most likely is the case. Even Curaleaf had to pull out of here, but I don't think people read the financials. I think that the total was only 50 million that they had done across all 3 states. And that's pretty pathetic. I mean, that's you shouldn't even been here if that's all you could have done.
Wow. Now the lovely data proprietary tool question, because Travis loves to talk about this, doesn't he? Wants to be very careful and hold his cards closely about what he can and can't share. But I think the most important thing is that you and I have touched on this, how this could be one of the, if not most sophisticated data proprietary tools within the industry. For the viewers that are new to this webinar, can you give us a rundown of what the data set looks like?
Sure. So we set out to answer some questions, and I'll give you a little bit of background and how we kind of approach the problem. Before I came to Polaris, I'd spent my career in traditional real estate. I was at a large hedge fund in New York, and we would buy data from REITs and CoStar. If any viewers are familiar with that, they're 2 of the largest commercial real estate data providers out there. And we would buy this data, and we would use an API, and we had a team of about 10 to 12 quants, and they would analyze the data and help us come up with the default loss probability models for the broader CMBS market, which is a $500 billion market. And so I saw the power of what big data could do. And so when I started focusing on this space, none of those data providers track cannabis properties. And so we had to go out and get the data first. So we founded a separate data company. We have a best-in-class data team, and we're scraping data today from over 100 different sources we're scraping it monthly and creating time series data that helps us track and better understand markets. And one thing I can share with the viewers here is one of the first insights we got, in early 2020 was in California, and every state's different in how they provide data, but in California, they'll publish all the license data for the state. They'll publish addresses for dispensaries, but they won't publish addresses for cultivation or manufacturing facilities. And for security reasons, they don't want people to go and rob them. And so we use alternative data sources, and we end up mapping every facility in the state of California. And to give you an idea, there's about, call it 6,500, almost 7,000 cultivation licenses. And so we're able to actually map all of those. And we know whether it was an indoor facility, a greenhouse facility, an outdoor facility. We know who owns it. We know exactly where it's at. We know how much they can grow, et cetera. So it was a really powerful first insight that we said, this is really helpful in us understanding from a real estate perspective, the footprint. And that was, again, one of our first insights in early 2020. The data's only gotten exponentially more powerful and interesting as we're pulling in even more data and kind of seeking to answer questions that we all have in the market, that the data just has not been widely available. And I think we have a big edge in the space.
So
where do you think that data could go in terms of what else you can do, like in forward-looking initiatives? Do you think you could even, build something that can help your underwriting practices even better, or provide you even a more granular look at the market?
Yeah, it's always a work in process. I'd say it's kind of like your proverbial Golden Gate project, where once you get to one level of hey, this is what I wanted, you think of like 10 other things you'd like to know. And if only I got some of this data and some of that data, maybe we could come up with some sort of framework around that. And so it's constantly progressing and moving. Ultimately we'll see where it all goes. But the whole point was to get a better understanding of the market and give us an edge in underwriting and deploying capital in the space. It's getting pretty impressive, and it'll be interesting to see where it goes.
So is the idea, like, maybe explain and determine the enterprise or lending value of an operator in a limited license versus an unlimited license state? And that's a question really for both of you.
Sure. You mean for the value of the operator?
Yeah. Yeah.
So if you want to talk about like enterprise value in a limited license state, it's typically profit margins are typically much higher because you don't have to compete with as many players. And so you almost have, this kind of government mandated ring fence around new competition entering the space. And so what we typically see in markets, all markets, some because of the limited license nature, it happens at a slower pace. But what happens is it goes legal. There's not enough supply. There's too much demand. Prices are through the roof. You don't have to be efficient to be able to make money. As long as you can grow it, you can sell it regardless of quality and regardless of, a focus on expense line items. And then what happens is more people raise more capital. They open more facilities, and then more, supply meets demand, and usually surpasses demand for a period of time, and prices go down, profit margins go down, and some of the weaker players in the space ultimately don't make it. And then the stronger guys weather the storm, and the market finds a stabilization. And so, so what we see there, and what we've noticed in unlimited license states where you don't have this kind of government mandated lack of competition, is these guys have had to shift and get efficient faster than others. Not only in California is known for producing the best quality products because they've been, it's been medically legal since '96.
Right.
Big head start on everybody else. So it's known for some of the highest quality products, but it's also been known as a tough place to drive profit margins. And but we are seeing operators outperform in this market. And what we've noticed is that they've been focusing on the expense line item first. They've been not only, because you can't control always the pricing, you control your quality to a point, but then you're subject somewhat to market demands. You buffer yourself by having a brand that you're selling to the end user, so that helps protect your margins. But then on the expense side, it's about how do you drive those efficiencies? And it's a $27 billion a year market. You'll hear some people say it's tough for cannabis companies to make money. Sure, some of them had an issue making money, especially as they've tried to grow simultaneously. But I don't believe there's a $27 billion a year industry that can't turn a profit. I mean, if you want to take it to the most extreme, you can go to grocery stores. They operate on a 2 to 3% margin, and so obviously a gargantuan business. And so it's just that the industry is finding its footing. We view it as the next leg of growth as the industry continues to mature. Is you're going to find these expense savings, you're going to drive profit margins like every other industry, and it's going to continue to grow.
So let's wrap this up towards the end and we look at the fund itself. You have investors that are obviously interested in the fund and how they're going to obviously get a return on their investment. You and I have talked, Rob, in the past about the growth trajectory. You know, maybe explain a little bit as to where you were 3 years ago as far as overall lending assets, where you are today, and what your plan is within the next 12 to 24 months, and how that's going to benefit, obviously, investors who are involved within your fund.
Yeah, so we're about, I think, around 100 million 3 years ago. We're at about 376 million today. Our goal is to be the leading lender and the most experienced lender in the sector, specifically for cannabis. And we feel that, you know, this is approximately up to a $50 billion asset class for the real estate when all 50 states are legalized. And, you know, we feel that a $1 billion fund is easily can fit within that sizing of the market. And, you know, so that's how we think about it. And we think that there's plenty of room for banks, other lenders to be in the sector. It'll take an enormous amount of time for anybody to catch up and figure out the things that we've done and build the relationships that we've done. But, you know, that's how we think about it. We do believe that we'll be probably getting to that $500 million mark in the near term, and our goal is to get to the full $1 billion mark. And you know, we think that that's the right sizing for this for our equity on the size of the fund.
What do your annual returns on average look like? And is there a monthly distribution that's provided?
Yeah, so our target yield is 12 to 15% net IRR monthly returns. And so that's our target. There's fluctuations in each of those months, but at the end of the year, your total on month 12 should be, you know, no less than that 12% is what we're shooting for. But we believe that we'll be able to start climbing that back up to where we need to be. We would like to be closer to the mid-teens, and we have some strategies to get there that we'll hopefully be announcing here with that highest rating that we just got last week of the A flat being issued. We're excited about that, and we're looking to be able to utilize that to reduce our cost of capital.
Hey, Rob, I want to stop you there because we didn't bring that up. The Egan-Jones credit upgrade, that was a big story. Can you just touch on that a little bit more and what that means for Polaris?
Yeah, so in the cannabis sector, both for publicly traded companies and privates, BBB+ was the highest rating ever issued. The first to do it was Innovative Industrial Properties, multi-billion-dollar equity REIT for cannabis, was the first to do it. We were the first private company to do it, and we matched their rating of BBB+. That was the cap for everybody in the entire sector until last week. And last week we were able to supersede that on our bond, and our bond has now been upgraded to an A flat, which is 2 grades up for a secured bond.
Wow.
Yeah, I'd just like to put a little finer point on what Rob said. We weren't just the first private company; we were the first debt fund to ever do it, public or private. So, you know, it was another first for us in the space.
Right. Something before we finish too, and we've had this conversation before, Rob, is just how you applaud obviously safe banking of passing. So for people to understand the private versus public side, maybe explain, Travis, feel free to touch on that as well as to why you think it's important, even for your company to grow, for safe banking to pass.
Sure, I can touch on that. I mean, we want continued access to capital markets for this. I mean, that is part of just the growth cycle of an industry and what it needs. So the more things that take away these barriers due to the conflict between federal and state policy, the better. The more equity capital that can flow into the space, the less hampered. And again, all of this won't be fixed with safe banking, but we view it as like a step forward in the right direction to ultimately provide the right environment for growth of this industry. No new industry has ever had to try to grow with these. One, there's a tremendous tailwind behind it, which is fantastic. Growth, but there's 280E, there's a conflict between federal and state policy, there's a lack of liquidity in the capital markets, there's all of these things that tech didn't have to deal with, and none of these new industries that ever had to deal with it. And so there are headwinds it's facing. And so we think one more brick in the wall as far as saying, hey, we're going to address this item, we'll hopefully continue to build on that. And there will be a normalized operating environment for these guys, which will be better for everybody.
Rob, you want to add to that?
Sure. I just want to reiterate that we are very, very supportive of any meaningful legislation that helps out the sector. And safe banking looks like it's going to got the most tailwinds right now. You and I have been speaking for a long time on legislative actions and things like that. And I've been fairly dovish on any legislation passing because of the choke point in the Senate of needing the 60 votes necessary. And I understand politics. I know some of these people directly, and that's been the primary reason that I would just say, look, I just don't see that happening. However, this Congress, this time, why I'm moving more towards hawkish and a little bit away from dovish, is that this is the first time that not only is the Senate going at the same time as the House, but it looks like the votes are already there on the Senate side. Now, it's easy to lose those votes as they go through negotiations, but it's my understanding that they've already negotiated this between the two, the House and the Senate. And so this is where things get, if you can pass one on the House side and then on the Senate, when you come into ratification, that's between those two houses, between the Senate and the House. That's when you lose a lot. It's much more difficult than people realize to get those things through. And it looks like this time that main pieces of the bill have already been agreed to by both parties, and the votes are there. That's massive, and it's massive. Also, a super important point that you and I both learned in Miami was I was concerned that now that the House has gone back to the Republicans, McCarthy is from a conservative district, that now you had a new potential choke point of that McCarthy wouldn't bring it to the floor vote and he could just stop the bill that way, because if you don't take it to the floor vote, you can't move the bill forward.
Right.
And what we learned, and this I had heard about, but I didn't think it through of how it mattered in cannabis, was that in last Congress session, Nancy Pelosi actually didn't have the votes to get reelected. And so that her party was so fractured that she had to give up power to get reelected. And one of the main things that she gave up that matters here in this conversation is that a simple majority vote in the House can bypass and get straight onto the calendar of the floor. That takes that power away from the speaker. That's an enormous power to just keep a bill off the calendar to be voted on. And so now, so basically what I'm saying, all the elements are potentially there to go this time. And we'll see what happens here. It would, we'd really like to see it. I think it would be great for the industry. And we're hopeful that it does. But it does take enormous amount of things to happen, and both parties are so against each other. And even though both parties are supportive of cannabis, it's the nuances between what they support, other than just saying, yeah, I broadly support cannabis. And so that's what people misunderstand.
Yeah. Well, I think the big takeaway we get each time that we have conversations with you guys, but for what you kind of reiterated here today, is just making sure you do your homework in anything that you do, which you guys basically are providing by example. But I want to appreciate both you guys, for checking in, Anthony and Ben as well, being part of our panelists as well. Any closing comments that you guys would like to add? And then most importantly, if there's any further questions that people want to reach out to, who they should be in contact with?
Yeah, so they can reach out to our team at ir@polariscg.com. That's IR for Investor Relations, Polaris, PELORUSCG.com.
Perfect. All right, everybody. I hope this is helpful for everybody, but let's continue to have some of these conversations, and To our viewers out there, again, thanks. We appreciate you checking in, and we plan to have more of these conversations to further educate. But reach out, like Rob said, with the email if any questions that we have, and we can start to incorporate that stuff in future webinars. But again, appreciate everyone's time.
Sounds good. Thank you.
Thanks, guys.
Thank you.
Thank you.
Take care.